Okay, a good loan fundamentally to my mind is a loan which is done for an asset which is going to appreciate in value. So there are two types of assets really to understand. So one is an appreciating asset and one is a depreciating asset. So now your home loan is a good loan because even if the rate of interest that you're paying on your home loan, even if that's say 10% or 11%, ultimately your house is likely to grow at the rate of 14 or 15%. I mean, that's the real estate experience that we have in our country from the last 15 or 20 years. So therefore, that's a good loan. Your education loan may not immediately show you a tangible benefit, but that is still a good loan because that's an investment that you're doing in yourself. So therefore, it's hence a good loan. Now, bad loans would be loans, which are typically unsecured in nature. I mean, things like your personal loans, things like credit card loans. They're very expensive. That's because the company is taking a lot of risk on that money and say that what if you don't pay back? Of course, they're going to try every rule and everything legally possible to try and get the money back. But the thing is that loan is temporarily normally that loan is a temporary loan in nature. It is done essentially for fulfilling those luxury needs and for those needs of a gadget or the needs of getting something that you can do with, or you can help yourself, maybe wait for about 6 months before you get that gadget actually, and whether you actually make that money available to buy that particular product. So therefore, I think it's something that you would want to classify as these are critical and therefore good and secure and appreciating. And those which are not so good are the ones that are depreciating, and the ones that are done more for purchase of luxuries, those are not so good loans. I mean, typically what happens to a car? The car will depreciate in value. As soon as you drive the car out of the showroom, you've lost about maybe 5 to 10% of its value. Yes, that's a bad loan. Because you see, what happens again is, it's a bad loan, it's hypothecated, that's the good news. Because the company has the car as an asset, therefore, the rate of interest is a little lesser than what you would pay on a personal loan. But if you had to buy a car and if you didn't have the money, then what else is the choice? Then you have to buy an auto loan. So as long as you can afford it, it's fine. Because unless you're going to hold the car for like the next 20 or 30 or 40 years where it becomes a vintage and then again it might appreciate in value, but that normally doesn't happen. So typically a car loan is not an essential loan. The only loan really that qualifies as a home loan and an education loan.